Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Earning his chops as a macroeconomist on the sell side, Alberto Gallo has seen the pendulum of risk swing from extreme fear to euphoria. During his tenure at Goldman and then at RBS, where he ran the global macro credit research product, Alberto provided buy-side clients with key insights on seminal volatility events like the global financial crisis and the Eurozone crisis. Now as a partner at Algebris Investments, Alberto leads the firm's macro strategy effort, a credit-oriented portfolio designed to navigate the ever-tricky terrain of present-day markets. Our conversation considers portfolio construction in a world starved of yield, of low cross-asset risk premia, and one in which the potential for more drastic policy response may be on the horizon. On the changing nature of volatility in markets, Alberto provides thoughtful insights. He points to the increasing degree of forward guidance employed by the world's largest central banks, a factor that has depressed volatility and led to more days of sun for markets. But since there's no free lunch, days of rain, while fewer, have become more substantial storms. On inflation, Alberto points to a bottoming of CPI in the U.S., even as structural drivers of low inflation like demographics and technology are likely to remain going forward. As the view that monetary policy has lost some of its punch and may be responsible for increasing income inequality, Alberto considers the trend towards lower central bank independence and greater cooperation with governments on the fiscal front. Will it work? In Alberto's rendering, it might, but it's all about how a much more unified version of fiscal and monetary policy is deployed. I hope you enjoyed this episode of the Alpha Exchange, my discussion with Alberto Gallo. My guest today on the Alpha Exchange is Alberto Gallo. He is a partner and portfolio manager at Algebris Investments. Alberto, it's great to have you today on the podcast.
Thanks for having me.
Excellent. Well, I'm really eager to have this conversation. I've been following your work, at least what's made available to the public, for a number of years now. And I remember back in that super low vol period of 2017, you'd written some really thought-provoking analysis on just the nature of what was causing the incredibly depressed levels of volatility. So I'm sure we'll get into that and a bunch of other things, including negative rates and monetary policy effectiveness. As we get started with the conversation, why don't you give us a little bit on your own career trajectory? How is it you came to Algebris? What was the period before that, and how did you get into the markets?
Thank you. So we manage 12 billion at Algebris, predominantly in four types of strategy. There is an equity long-short strategy, a private debt strategy, a long credit strategy, and I manage a macro fund, which we started in 2016. Previously, I was in macro research at Goldman Sachs, and before that at Merrill Lynch. I worked for over a decade between London and New York, covering and trying to understand fixed income markets, government bonds, investment grade, high yield debt, emerging markets, covering the full spectrum. My passion for economics comes from earlier on. When I was a student, I was trying to understand the world and studied both the classical economics, but also some sociology and psychology. And I think what I've learned the most in my years as portfolio manager is to understand not just the laws of finance, the textbook, but also understand the psychology of market participants and understanding when there's euphoria and fear of missing out versus when there's panic and the odds for something are implying a very cheap valuation. So it's been so far a very intense and very good experience. We have generated a good performance for investors in the last 3.5 years, and the fund I manage is now over $600 million. So, there's always bigger targets and in returns ahead of us, but we're happy so far.
You're sitting there managing rates and credit and other macro instruments. You're in London and in Europe, where I would say is maybe not London, but Europe being the epicenter of this negative rates phenomenon. I'm wondering if you could kind of take us back a little bit and just give us some of your thoughts on some of you mentioned euphoria, you mentioned panic, this pendulum that can swing in both ways. And I love the fear of missing out phrase. If you go back to other parts of your career when markets were, let's say, in a bout of intense volatility, can you highlight what was happening? What do you think were the proximate causes of, let's say, a specific episode of volatility? What was the interaction of, let's say, finance and economics and then maybe central banks? Walk us through some of your insights on one of those periods of elevated vol.
When you think about volatility and also the level of entropy, the level of dispersion within the market today, what you see is that we're living a very different time from before the crisis. Essentially, since 2009, central bankers came to investors and asked them, we're going to give you less volatility. We're going to give you more days of sun and less days of rain. For someone working in the city of London, where it normally rains 300 days a year, that's a great deal. So investors cheered at this deal with the central banks and accepted to have less days of rain for more days of sun. So let's say you have only 5 days of bad weather per year. What we didn't know is that investors would get used to the sun and herd into similar positions. And the 5 days of bad weather would be actually hurricanes and not just normal rain. Since the decade of QE and loose monetary policy, we have witnessed a polarization of volatility. There's more days of calm in the markets during which investors are forced to herd into carry trades, into trades that allow them to justify their fees. And then we have fewer days of much higher spikes in volatility, which sometimes turn into flash crashes or into complete drought of liquidity. One example was last year. In 2018, we had an environment where central bankers were actually trying to withdraw stimulus. At the end of a very loose monetary policy decade, the Fed said, we need to normalize rates to create some room to counter another slowdown. Unfortunately, though, most developed economies have not reduced their levels of debt, with a few exceptions. And what this means is the economy has the same problem, carries the same weight as it did 10 years ago. We have the same problems that caused the crisis. As the Federal Reserve tried to normalize rates and other central banks tried to follow, markets became jittery. Investors started to suffer outflows, and some funds in particular suffered outflows across emerging markets in Europe. So we had an environment where credit markets, even with still positive growth in the economy, started to price in a recession, driven by the unwind of leverage, the unwind of long carry positions. And at the end of 2018, around a fifth to a quarter of bonds in the European high yield market and also in the US high yield market dropped over 20 points. So essentially, we were pricing a very high default environment, even though interest rates were very low. So that was a very clear case of panic, but also something that may become more frequent or may happen again if central banks try to hike. In fact, what we had this year is a U-turn where the Fed, first of all, but then also other central banks started to cut rates again. And in my view, we are stuck in an environment of loose policy for the foreseeable future, what we called 5 years ago QE infinity. In September this year, Mario Draghi at the ECB, in one of his last meetings, announced that QE would continue for as long as necessary. So we are stuck now in a low interest rate environment. And the challenge for investors is very different from what was the normal investment framework and environment before the QE decade.
You make an incredible point around this notion that the average day, and there are more average days, is one of pretty muted volatility. And then you have these outlier days, which probably happen less frequently, but are of greater magnitude. Sounds like an incredibly difficult kind of environment in which to price and manage risk. It seems quite unique to, I think, the post-crisis period. And it's funny, I'm thinking back to the U.S. tech bubble, which, of course, was the euphoria part of the fear of missing out. And that was one of very, very high volatility, but it was basically high volatility every day. It was these stocks were moving 2 to 5% a day, but doing so consistently. And now, as you point to, the average day is pretty much nothing. Maybe it gently moves up, but then you get these flash crash type moves, these big risk offs. How do you adjust to some dynamic like that? What's the shift in the risk management framework that tries to survive through a challenging period like this?
And this is a great question, because when we start to think about providing a liquid alternative to fixed income investors, it was actually 4 or 5 years ago. I was still on the sell side, as a market economist working for banks. I was approached by institutional investors and they told me, Alberto, we like your research, we like your market calls, but now it's time to get a real job and start investing. And we started to think about a strategy that could survive and generate positive returns above inflation in an environment with very low yields, permanently low yields, which is what happened a few years later. When I started to think about this, one of my guides was the study on fragility by a number of economists and mathematicians, including Nicholas Taleb in his Anti-Fragile book, where philosophically he makes a very good point on the nature of fragility. And if you think about nature, dinosaurs were very fragile. They were very large and they could only survive eating a lot of food every day. Ants are very robust. They can survive very bad natural events. A hurricane, a earthquake, you would still have ants. And there's very few anti-fragile creatures in nature. Think about a hydra, where if you cut a head off, 2 other heads grow back. Now, the equivalent for monetary policy for fragility is forward guidance. If you push every market participant to know that interest rates will stay low forever and that volatility will be compressed, because central banks, by buying bonds, compress rates volatility, then investors will start selling volatility in rates. They will start buying credit spreads. Many central banks are buying corporate bonds as well. And then eventually they will also sell equity volatility until something goes wrong. And this is what happened in the first quarter of 2018, where central banks started to try to normalize rates. And as you know, we had a very, very sharp unwind in short VIX strategies. And then throughout the year, we had an unwind of carry trades. Essentially, forward guidance and loose monetary policy have stabilized markets today, but they also come at the price of increased herding, increased polarization in volatility, and increased fragility of financial markets. The anti-fragile version of monetary policy is macroprudential regulation, which tries to prick bubbles or contain bubbles. We know today that this is possible and it's probably necessary, unlike what Mr. Greenspan used to say. You can boost the economy for a while by inflating asset prices and by creating potential asset price bubbles, but eventually the fragility can hurt the economy. And the Bank for International Settlements has been very vocal on this, with research from its chief economist saying that essentially if you create a boom-bust cycle in the economy, you can have a misallocation of resources, for example, to sectors that rely a lot on leverage, real estate, finance. And eventually, when the bust comes, you have a permanent loss in productivity, what today economists call hysteresis. In other words, people that are structurally out of the labor market, or companies that are out of business because they've been working in a sector that has structurally less demand but was alive because of low interest rates. In other words, you end up with an economy with more zombies that are kept alive by low interest rates and lower productivity. This is why today we have a very challenging job as investors, which is to distinguish the good assets from the zombie assets. We don't invest in negative yielding debt. We think that our job to earn our management fees is to deliver investors returns above inflation and definitely above zero. So we invest in the fewer bonds that have positive yields that are left in the market. Only 5% roughly of the bond market currently yields more than 5. There's 20 trillion of bonds yielding either negative or very close to zero. So what is left are bonds that yield positive, that are not bought by central banks, and that carry substantial risk. So high-yield corporate debt, financial subordinated debt, emerging market debt in hard currency or in local currency, for example. Our job is to choose the bonds that yield positive, but increasingly it has also been to go short companies or sometimes governments that have unsustainable debt. And as you may have heard, this year we were short Argentina, which was a very popular long trade because we saw a very elevated tail risk before elections. Now, we don't think that because central banks continue to stay on a loose path, we don't think that despite that levels are very high, that we're going to have another systemic crisis anytime soon, at least in the foreseeable few quarters. What we are seeing, however, is a gradual deterioration in several sectors. For example, in the US energy, in the US healthcare sector, in the UK consumer sectors of the bond market where you still have unsustainable overhangs. So we're positioned investing in positive yielding debt, but at the same time avoiding or shorting those companies where capital structures are weak and business models are unsustainable.
So we're looking here at the S&P has made a new all-time high. You made the point about the negative or almost negative yielding debt. Bloomberg had it at, as of late August, it peaked, this is in the actual negative territory, at about 17 trillion. And we're down to 12 trillion. So, boy, the freeze is coming off the bond market here. It's an environment that one would have a difficult time making sense of, this sort of disparate all-time highs in equities and this, I guess, implied deflation view or low growth view that's coming from the bond market. Or maybe these two are enablers of one another. I wanted to go back to your comment on Greenspan because I thought I wanted to bring in a quote here that I've used many times. And I want you to give me your feedback because it does tie back to Taleb, I think, a little bit. In 2005, Greenspan was doing some testimony. So we're sort of peak housing bubble in the US, maybe peak of the leverage bubble and lows in credit spreads and so forth. And he said, history has not dealt kindly with the aftermath of protracted periods of low risk premia. So the idea that option prices of some kind, whether it's credit spreads or vol, or maybe even interest rates, stay super low for a long period of time, ultimately seems to end badly. Are we in some version of that now, in your opinion?
We could be in what historically economists call a period of financial repression. This is a period which in the past has been associated with very, very bad events, generally the aftermath of a war or periods of very high social disorder, where essentially savers are gradually forced to hold currencies that devalue or forced into assets that return much below inflation. One example of this is the aftermath of the War of Independence, for example, where Great Britain devalued its currency and had double-digit inflation rates, essentially defaulting on its debt, even though not on a legal basis, but on a de facto basis against inflation. Another example is after World War II, where Germany had very high inflation rates and other countries in Europe as well. In other words, this is described as a period where returns are almost forcedly negative against inflation. This is a very bad potential scenario for fixed income investors. How did we get here? Well, we got here because since the 50s and 60s, governments started to use public debt more freely, and after that also private debt. And because these levels of debt are today unsustainable and politically hard to reduce. To reduce debt means to introduce austerity and potentially lose elections. So we are looking at a potential shift to the left in the UK, for example, with not this year, but in the future, with governments doing more spending or changing the independence of central banks, for example, with modern monetary theory, MMT. We're looking at a potential raise in minimum salaries or universal basic income. In the US, many of the Democratic Party are proposing such measures. Essentially, if you take a step back and think about the history of today's financial system, it is a product of what happened after World War II. We had Bretton Woods and the gold standard, but this didn't last for many years. It worked only at the beginning, but eventually there was a very substantial imbalance, and the US accumulated too strong a dollar. So we exited Bretton Woods. We entered a world of fiat currencies, and later on a world of fiat credit, where bank regulators started to loosen standards for commercial banks to lend. And this was accompanied by the creation of Fannie Mae, Freddie Mac, the introduction of subsidies for mortgage lending. Essentially, when the developed world started to lose the boost of growth following the post-war recovery, governments came up with what Rag Rajan, the former chief economist of the IMF, called let them eat credit policies. The Nixon shock, for example. If you couldn't afford your house or your car or your university, Uncle Sam would lend you the money to get there. And that was the start of the American dream, to some extent, subsidized by the government in the form of a loan. But this also created increasingly higher amounts of debt, which central banks accompanied by cheapening the cost of interest rates and increasing the ability of kicking this kind of debt forward. We get to the 2008 crisis. We react to this crisis with even more monetary policy. And today we're stuck with the inability to normalize this policy, with some central banks cutting in very deep negative territory and saying they're not done yet. Now, my fear, answering your question, is that we're one slowdown away from an even more radical source of quantitative easing. It could be central banks buying more assets or devaluing their currencies in another race to the bottom. This would generate inflation, but the difference today is that this would be supply-side inflation. It would be inflation because of money printing, not necessarily because of stronger demand in the economy. And the difference today is that we start with very low interest rates and investors locked into returns which are already very low on a nominal basis. In some cases, flat or already negative to inflation. And these returns would hurt savers if inflation goes up. That's exactly our concern when we are thinking about our fixed income strategies and trying to deliver positive yields in risky assets, picking the assets that are sustainable.
Such an interesting topic, the return of capital, i.e. picking credits that you feel good about the risk of default on or the probability of repayment. And then, of course, there's in what form of currency do you get paid back in? Is it in a stronger or weaker form of that currency via inflation? And there's not a ton of focus on that, it seems. Most portfolios, I would say, are not really set up very well to absorb some increase both in the realization of higher inflation or, and of course, these things are always entangled with one another, a bump in inflation risk premia, right? That risk premia has been incredibly low for a long period of time, I think for good reason, right? Because inflation's been largely absent, at least as reported by the various governments. Take us through, as you sort of step back and you look at the kind of totality of factors here that are both pushing inflation higher and lower. And as you talk about the government response, whether it's MMT or something that's a bit more drastic, what do you think the next 5 years might bring? And of course, it's not asking you for prediction, but the types of things that you think markets and market prices may not be fully appreciating when it comes to the pathway of future inflation.
Over the past few years, a lot of investors have bought bonds for capital gains and sometimes equities for yield. This isn't sustainable in our view. We are today with very low interest rates. We have 10-year U.S. Treasury, which just got close to 1.5% and now bounced a little bit higher. We have a 10-year bond yield of minus 35 basis points, with inflation rates which continue to be low, but in some cases are slowly rising, like, for example, in the United States, where next year will be in the range of between 2 and 2.4% in CPI inflation. Now, if we think about inflation and why it is so low, there are some structural drivers for this decade of low and stable inflation, which we experienced, and also the previous decades, which, following the famous Volcker intervention, started to see a declining inflation rates. In part, it's demographics. The baby boomers phenomenon has turned into a much more stagnant population in developed countries. In part, it's technology. Large companies today allow you to have a much better, more efficient price discovery. You can know which retailers are selling at what prices in a second with the internet, and you can choose the cheapest one. You can have all the music you want in the world with Spotify at just over $10 a month. And the current technology essentially allows for deflationary dynamics across consumers and for a winner-takes-all effect, where large companies eat up market share from the middle and small businesses. This is not great for competition and future productivity. As you know, a lot of sectors in the US economy have become more oligopolistic, but it's deflationary, and in the near term, it's good for the consumer. Another low inflation dynamic has been the independence of central banks. Governments are often tempted to lower interest rates to boost credit. Turkey today is a case in point where President Erdogan has been arguing that low interest rates actually cause inflation to go down because he wants credit to expand. But normally, central banks have gotten more independent until the last few years, over the past decades. Some of these trends are still in place. Other ones are changing. And one of the ones that is changing potentially is fiscal discipline and the attempt of governments to navigate within a contained range of deficits, as well as central bank independence. We see more pressures both in the US and the UK to influence the direction of central bank policy, or potentially in the UK, where Governor Carney's term is coming to an end, to appoint someone who is more conducive to partner with government on expansionary policies. So these trends could at some point push inflation higher, but not because the economy is growing faster. On the other hand, because governments are trying to essentially print their way out of trouble. Ultimately, we could say that a too prolonged decade of loose policy from central banks is almost causing their own demise, has almost been a self-defeating act. Quantitative easing helped asset prices to go up. It also helped people with assets to do better than people without assets. Of course, it eliminated the worst case scenario, eliminated the very deep recession that we could have had in 2008. It made it more shallow and less deep, but also increased inequality. And inequality is also the reason why today a lot of electorates are asking for solutions, are asking for more spending. And ultimately, this could create an increase in inflation in the next 5 years.
Let's run with that a little bit. You pointed to, one, your concern that we are one significant slowdown away from not potentially having the tools to act decisively given where we already are, and the potential that monetary policy has lost some of its punch. There are folks out there, I think BlackRock's Investment Institute via Stanley Fischer had written a piece that's essentially calling for some framework in which governments and central banks are slightly more joined at the hip. My understanding of central banks is that independence comes and goes. The Fed's been around for a long time. It really got its wings of independence more in the 50s. And we know in even the early 70s, there was quite a lot of hand-wringing from folks like Nixon to his central bank head. What do you think that trend might look like? Do you see more of that coming? And do we have the cooperation necessary to bring about something that more closely aligns fiscal and monetary policy? And do you think it's a good idea?
We're definitely going towards decreased central bank independence. and a closer cooperation between central banks and governments. Whether it's a good idea or not, I think it will depend on how governments will spend. Let's take a step back. Central banks in 2009 started to move from monetary policy, the standard way, call it 1.0, to monetary policy 2.0. They started to lower interest rates more aggressively and in some cases to negative territory and to buy assets in the market, not just government bonds, but also mortgage-backed securities or corporate debt like the ECB or the Bank of England. So this is monetary policy 2.0. Did it work? It did work in the beginning to respond to an emergency, but it created a lot of collateral effects over time. One of them is asset bubbles and increased market fragility. That's number one, which we discussed before. A second one is a misallocation of resources. In other words, you keep companies alive, which are not necessarily profitable, and you encourage industries that rely on leverage versus others. The third consequence is the third collateral effect is more dangerous. It's inequality, both corporate inequality and social inequality. Large companies today encourage the building up of barriers to entry. They lobby to close competition, and they also have very large economies of scale versus small companies. Large companies borrow near zero rate in markets. Think about Amazon or Apple or Google, and they have the ability to buy smaller firms before they become a rival. This creates good profits for shareholders in the near term, but it can also reduce competition. And capital in the end is about competition, or should be about competition, and that's what's driving productivity in the medium term. So QE 2.0 worked as an emergency tool, but the patient, which had a heart attack in 2008, has been now stuck with an anesthetic for over 10 years. And it did not have an operation. Some of the sectors, some of the parts of the economy are zombified because of this decade of anesthetic. There is debt overhangs and there's inefficient companies around the world. Today, in 2019, for the first time, investors started to realize that, and markets started to realize that QE does not lift all boats, and markets started to realize that there's a painful lesson at the end of a low interest rate cycle if your debt is unsustainable. Think about Argentina, for example, or Lebanon, which both went into distress with bonds dropping over 50 points, or many companies in the UK or the US in levered sectors. What will happen at the next slowdown could be QE 3.0, a new version of quantitative easing or aggressive monetary policy, trying to balance out some of the side effects created by the previous ones. I think it would be more efficient. I think it will be also better to expand monetary policy in a way that it helps everybody and not just asset owners. For example, financing projects that create improved productivity in the long run for the economy. So real economy investment, investing in infrastructure, investing in technology, investing in education. This is one version of what you would call good QE for the people that some governments are thinking about. It does obviously involve a loss of independence of central banks and potentially higher inflation, but it can improve long-run productivity. There's also a bad version where governments just expand the money supply and print money to favor or to increase short-term spending and to get reelected. This is a bad version because it will create inflation in the near term, but it will not improve productivity in the long run. So it will not contribute to the normalization of debt levels.
I wanted to run with this topic here on inflation again. And one of the things that, as you're running this book of fixed income and credit assets, that you and your team must have to focus on all the time is the correlation between, let's say, Treasury bonds and credit spreads. In normal times, these things are mitigating to one another. When you have your risk off, credit spreads widen, but duration rallies, and then vice versa. Maybe you give a little bit back on the duration side when credit spreads tighten and you're in a risk on period. There are those special periods, and the taper tantrum of, I want to say 2013 comes to mind, where perhaps the market misinterpreted Bernanke, but you had rates go up and credit spreads widen simultaneously. And it's happened one or two other times in recent period. But for the most part, we've got this very strong risk on, risk off regime. I just love for you to share some of your views and thoughts on the interaction, let's say, between interest rates and credit spreads from a portfolio construction standpoint?
This is a very important question. A lot of strategies have been anchored around a certain level of correlation between bonds and equities. If you can think about normally balanced portfolios, 50-50 or 60-40, where part of the equity volatility is absorbed by constructing the portfolio so that bonds are a large part and offset part of the equity moves. In the risk parity strategies, this is done on a levered basis. So bonds are a bigger portion and weighted by the amount of risk that can offset equity moves. It has worked very well over the last decades because over time we had stocks going higher and interest rates offsetting the daily volatility moves, but also over time going tighter. So we had both appreciation in stocks and appreciation in equities. This only works if the reaction function of central bankers tends to be favorable and to be wary of the moves in the equity market. It only works in an environment where inflation is stable. There's a lot of fixed income strategies which have benefited very much from the decline in interest rates. And we have been long duration at some point in the last 3.5 years as well, particularly in the first half of 2019. However, I think that the returns generated by long duration positions, which have benefited from the decline in interest rates and the flattening of yield curves, may not be so sustainable in the next decade as much as they have been in the last decade. Our approach to portfolio construction is much more active, and it is more barbelled. Having the market become more polarized, we keep a high portion of liquid assets in our portfolio to be able to have optionality in case assets drop. We keep a portion of positive yielding assets, which were long, where we think there is an appreciation story because of a change in regime, because of a deleveraging of the company. And then we use not just duration as a volatility absorber, but also shorts. We use a number of shorts in credit assets, which we think are unsustainable, rather than using duration as a portfolio dampener of volatility, because we think that the reaction function of central bankers at some point may change. We're not talking about necessarily the next 3 or 6 months, but we think that if inflation has not come naturally in the economy because of technology, because of demographics, it may come to us because of politics.
You mentioned shorts, and it just got me thinking about defensive trades and maybe hedging. And you also used one of my favorite terms, anti-fragile, from Taleb. And some might argue that long optionality is really truly one of the only anti-fragile positions in markets. It's also proven to be super expensive over time, just given vol bleed and roll down. How do you think about that part of the portfolio? Is there value in optionality? We have relatively low option premiums, but we also have a market that has not proven to deliver a lot of volatility. What's the balance for you as you think about defensive trades in terms of option premium?
The option trades is something that we use regularly to try to capture upside or downside, and especially to capture the tails in the market where we think that the probability of events is underpriced. However, because of the loose stance of central banks, sometimes, even though volatility tends to be cheap, we have refrained so far from buying volatility on a constant basis. And the reason is that until the reaction function changes, this is probably going to stay. However, the low volatility environment can be disrupted, as we have seen several times. And when it is disrupted, the disruption, the distribution of volatility has a much bigger tail, has a much fatter tail. You can see this if you do a histogram of the VIX before the crisis and after 2009. The right tail is much fatter. You have more days of sun, but the bad weather days are really, really bad. And without going into complexity, we tend to try to compare what we think are the real probabilities with market implied probabilities and buy cheap volatility. But sometimes, rather than options, you can find cheap volatility using debt instruments with very high convexity or low convexity and go against them. There are cases where different types of bonds or bonds versus credit default swaps offer different liquidity or different prices, and you can create a position with a long volatility payout, even though you're not necessarily buying an option per se. Sometimes these are trades that we like a lot because sometimes when markets become illiquid, having a short in an asset that is liquid and can become illiquid can hedge you, can protect you a lot more from that type of environment.
That's very interesting. So we've covered quite a bit of ground here with negative rates and central banks and inflation and your views on kind of the financial system of vol. As we wrap up, just in terms of the types of areas of investigation for you and your team in terms of market risk or just the dynamics around policy versus markets, what are some of the things that are truly top of mind for you, things that maybe we haven't covered yet that you guys are working on?
What we are trying to understand is in 2020 is the implications of a shift to the left in global politics. And also later on, we are investing in understanding the economy and markets using artificial intelligence and trying to integrate better that with the intuition and the feel for markets that humans have. We think that a lot of purely quantitative strategies have an edge in trading the market on an intraday basis and capturing all the patterns and the small moves in the market, but humans still have an edge in understanding the changes of regime in politics, in society, and sometimes these are key to understand when a country's debt goes from sustainable to unsustainable. So we look forward to a lot of big, long or short fixed income trades in the coming years.
That's really interesting. And Alberto, I really wanted to thank you for your time today. As I expected, we really dove into some great topics there and appreciate your time today.
Thank you for having me.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again.